Hello, everyone. Welcome to the Acre Exchange. My name is Joe Furlong, and I'm pleased to be moderating a wonderful conversation with Dick Kazarian, who is our managing director of the Bar Analytics Group. Before I forget, I actually have the comments on. So if you're in LinkedIn, you want to make a comment, it should pop up and we can answer it. But in the meantime, Dick, welcome to the show.
Good afternoon, Joe. It's a delight to be here. Thank you for inviting me.
Wonderful. I have so much to talk to you about because I'm very curious about a lot of things. But let's start it really simple. What does the Bar Analytics team do in general?
Sure. So let me just start by saying, what does a firm need analytics for? And basically, in our context, that can mean a lot of different things in a lot of different contexts. In our context, it's where you take a loan, you take information about a loan. It can be a small number of loans, it can be pools, it can be really in any context. And we're really calculating three kinds of things. One is we're doing valuations of those loans. So given a set of attributes and given macro factors, we either calculate a market price given a spread, or we calculate a spread given a market price. The second use case for analytics is where we ask ourselves, well, what happens if rates change? How much will that price move? So that would be in a hedging context. And that hedging context can be loans that have yet to be created for a loan originator in a pipeline, or it can be loans that have already been created that are sitting on a balance sheet or are waiting for some kind of securitization execution. And then finally, another example of where you need analytics is in stress analysis. And this is very, banks have to do these CCAR analyses where you run macro factor stresses, home prices down, interest rates up, and you calculate how the asset will perform, which will then feed into downstream models. So that's kind of. Oh, go ahead.
So it seems like to me that your work, if it hits all four corners of the MIAC enterprise, it's like regardless of whether it's valuations or hedging or whatever the case may be, your models that you built and your team has built have a direct impact on our analytics. Am I hearing you correctly?
Yeah, I think that's a fair statement. So MIAC is involved in lots of different business. We have lots of different business units, from valuation to hedging, brokerage, and so forth. And yes, we have built models which will support those business units, which is something that's, I'm not sure if we'll get into this, but we've had to create models which are sufficiently complex to handle the most demanding uses for any business unit. So instead of creating different models for different business units, which is very challenging to develop and maintain, we've basically said, okay, what are the most onerous business requirements for the most extreme use, and building models to satisfy that. And one of the big things with analytics is to understand what are the business requirements.
Yeah, so let's talk about that. Building these models is extremely complex, and a lot of people think it's a black box because of its complexity. And even going back to the credit crisis days of 2007, 8, and 9, a lot of people blame that, oh, people didn't know what they're doing. They didn't have the right models, this, that, and the other stuff. It's too complex. No one read anything. So how do you, first of all, at a high level, how are these built? How do you convey the details or how it works to the clients? How do they understand these complex processes that you've built to actually understand how it impacts what they're doing? Can you help us understand that?
Sure. So let me just take a minute to go through kind of the model development life cycle, and then I'll answer your question. Then I'll specifically talk about the great financial. As you can tell by the gray hair, Joe, I've been through a lot of crises going back to the peso crisis that most listeners will.
The peso. Hold on, the peso crisis. Let's take a sec. The peso crisis. I thought I heard a lot of things. What is the peso crisis?
That was when Mexico devalued the peso. I don't remember the year, but yes.
So why did they devalue the peso?
Pardon me?
Why did they do it? Do you remember? I mean,
I
why did
don't,
they?
I don't remember all. I think, it was an issue of unable to pay debts. So when debts are
Well, okay,
denominated in
all right. I
nominal terms, just I,
Remind me to tell you my story about when I was in Cyprus during the credit
oh
crisis
yeah,
during
right,
2013. So I think we have a lot of war stories. But anyway, I didn't mean to
yeah,
digress.
yeah.
Please tell me about the models. That's what I want to hear about.
Sure, sure. So I'll make this very, very brief. There's a model development life cycle, which will start with, what are making sure you understand the business requirements. Then there's the data acquisition, data preparation, data normalization, figuring out what data models are answering a question. So you're asking yourself, what is the data that is best, um, what data set is the best, or sets of data, we can get into that, that will address the questions that the model is trying to answer. Then you go through the model specification, then the estimation process. We do a tremendous amount of back testing, creating diagnostics, and then a big issue is putting it into our software. This is something that distinguishes between, estimating models in a graduate class in statistics or data analytics and actually doing this stuff in the real world. You've only just begun, as the song goes. When you've develop the model, you then have to get it into software, and do a lot of implementation testing. There's a lot of things that can go wrong when you're putting a model into software, and we have a whole process around that. And then after that, you give it, you hand it over to users. And at MyAC, we that would include both our production units who are doing the valuations and the hedging, as well as external software clients. So one of the nice things is we have a large user community that can give us feedback. The word that we use, here is the pivot word that we use is triangulation, where we have people coming together. And I would say that's one big difference, Joe, between being in a large. I've been at large organizations. I was at Lehman Brothers during the great financial crisis, and I remember walking out with a box in my hand,
That must
with
have
my
been
personal
horrible.
effects when we declared, when we put our European subsidiary into chapter 11. So yeah, have been ups and downs. And one of the differences between being at a small firm and being at a large firm is that at a large firm, there's a high degree of specialization, whereas at a smaller firm, um, everyone is a generalist. So these are tasks that pretty much the entire team works on. So once we've done all this, and I'm getting to your question, we document what we do, and the level of documentation will vary a lot. If we're talking to a highly regulated, depository or FHLB, those documentation requirements are very onerous to get through the model validation process. For less regulated entities, a money manager, they're less they're less stringent. We do a lot of validation reporting and so forth. And then we're doing ongoing performance assessment because models do get out of date. And that's, in fact, one of the requirements for this model validation. Model validation really came into its own as a result of the great financial crisis, where it was presumed, not incorrectly, that models were partly to blame for um, the great financial crisis. I think there's a lot more going on, but they did play some.
Of
They did
course.
play
I think there's a
some
lot
role.
of factors that went
But
into that, and I think models or poor models or no models at all played a
yeah,
role in it. So
yeah,
let me back up, and I'm gonna dive into one comment you had on it. You talked about data and data be able to do this. Clearly, data is the big driver. If you don't have data, you cannot build any models whatsoever. So where do you get the data? How do you clean the data? Because if the data is not good, you're going to get, you know, crap in, crap out, for
right,
lack of better words. So talk
yeah.
about just really the data portion of your process.
Sure, sure. So we build separate we're active in all the residential sectors. So that would be Ginnie Mae, GSEs, and non-agency, as well as portfolio non-agency securitization, as well as portfolio loans. So in every case, although we use the same framework for these models, each of these models have enough distinguishing features that that require really separate modeling efforts for each of these sectors. So to take one example, something that we've been talking about for a long time is that about the only thing that FHA and VA models or loans have in common is that they're both securitizable into Ginnie Mae. Other than that, the attributes are very different, and importantly, the behavior conditional upon the attributes is very different. So FHA, even if you control for FICO and LTV and the usual suspects, FHA credit is quite a bit worse. And we're seeing it actually get progressively worse, and we have a couple of publications on that. Meanwhile, prepays on VA are super fast. They're hitting 50, 60 CPR at around 9 months of loan age.
Wait,
So we
hold on.
need
Well, hold on a
separate.
second. Which segment has a 50 CPR? And for its conditional prepayment rate, how
Yeah,
fast the loan pays off, that's what a CPR is. Which
yeah.
segment has a 50% CPR?
VA VA loans.
Why
They're
is
much
that?
more sensitive. It's in large part it's because their credit tends to be very good, and they've got the Earl the um, their streamlined refinance is very efficient, and they're right. As soon as you hit 8 months of loan age, and you don't have the net tangible benefit, that sunsets, prepayments really spike dramatically. So I
And
think it's better credit and a more efficient, streamlined process.
so in a VA EARL, it means interest rate reduction loan. That's what a EARL
Yeah,
means, just for
yeah,
everyone out
that's
there.
right.
Because I know the banking industry in general, lending industry is full of jargon and
Oh yeah,
acronyms, and we always need to be mindful that not everyone's in that world.
right.
So you have this uniqueness in the VA where you have relatively good credit. You
Yeah,
have the ability to do a rate term refinance relatively easy after a fixed period of time, and
right.
also they can get 100% financing. So
Yeah,
being able to do that, and even maybe even get cash out, is an incentive to be able for these borrowers to, for lack of better words, get their loans quite frequently. Am
yep.
I understanding you correctly?
Yes, that's right. That's right. That's
All
right.
right, so that's
And
the
we
prepay of 50%. I get it now. I would assume at 100% loan to value, the VA's offer, which is more than the FHA, which is 96 and a half. Granted, it's small, but you would assume that the delinquencies would be high in VA just like as in the FHA because the LTVs are so high. Am I wrong on that?
Well, the LTVs are very high. Especially for the purchase loans. For refinance loans, origination LTVs are somewhat lower for both programs, although they're still lower. But what we see clearly in the data is that conditional upon the LTV. So LTV matters. It matters greatly for both programs, for both credit and for prepays. But what we see is that you know adjusting for LTV, VA is worse than sorry, VA has better credit, has got,
Okay.
better credit. And this is something that's very important to, from anyone who's thinking about either building a model or interpreting models. So everyone is in the data business. The only question is either you're going to be good at it or you're not going to be good at it. And one of the important things when interpreting any, whether it's mortgages or anything, is you're never going to have all the attributes you'd like. There's always more going on. You get a data set, there's other unobserved factors that will drive behavior, but it's not in your data. I mean, you talked about the great financial crisis, and we definitely should spend a little bit of time on that. But the credit performance of loans, what we call the bubble vintages from 2003 to 2005, where it was subprime and Alt-A and all that stuff, and we were Lehman was very active in that. That's no nothing hidden there. We were very active in that. Um, what we saw is if we look at loans that were created after the financial crisis, even if you take GSE, because the non-agency market pretty much shut down after the, after the great financial crisis, we see that post GFC originations were had lower credit after adjusting for these better credit, lower credit losses than pre GFC, or the bubble vintages. And one of the reasons is the appraisal quality. And I know, Joe, you have a background in due diligence. The appraisal quality was horrible
Yeah.
prior to
Yeah.
the great financial crisis, and became much better, afterwards, especially after the Dodd-Frank reforms. If you recall back, pre GFC, the broker would do the appraisal shopping. The broker would bring the appraisal, which is now, that's barred by Dodd-Frank.
Yeah. Now they
But
have to go through a third party mediator to actually order the appraisals and do it the right way.
right. So that's something we know to be true. And this is why it's so important, Joe, to have subject matter knowledge. I'd rather have someone on my team who has good economic intuition and good subject matter knowledge that is the fastest programmer on the block, because it is critical to, you know how you use the data, what data you use, how you interpret the data, to come up with models which will forecast well. Right? Anyone can fit the past.
So let's talk about this. All right, let's back up. Obviously, in this day age, and frankly, my world, I'm about AI. My world's AI. The world is about AI. You would assume, hey, I could just get AI and create own logistic regression model for all these states, and it'll call it a day and let the brain do the brain thing, and just we can sit in the corner, do nothing, and maybe have no team or fire everybody. I would love to hear your thoughts on that, Dick.
Right, right. So I do think, right, and you hear machine learning, that's a wave of the future, and oh, you're using classical regression models. So yeah, I do think there's a role for machine learning models, that are machine learning models that are as a I do think there's a role for that. Yeah. So sorry, but they are not a panacea, and they will never replace subject matter knowledge. I think where they'll work, where you'd prefer some kind of random forest or something like that, is when you have a lot of variables where you don't have a lot of good economic intuition about how those variables will relate to one another and the impact they'll have, where you have a large amount of data because you need that to do the training of these models, and where there's not going to be policy interventions. There's not going to be, kind of exogenous changes that come in, like the appraisal reform. But we could come up with lots of other examples. So I think maybe credit scoring, where you have a lot of potential explanatory variables, fraud detection, anti-money laundering, those kinds of things. They're in widespread use, and I do think there's a role there. But
So
for
ultimately, what you're saying, AI could be used surgically in the
Yeah,
process. It cannot replace the entire
yeah.
process. Is that's what I'm
Yeah,
hearing?
absolutely, absolutely, and I think it's more sizzle than steak um, in the credit and prepayment world, where we do have a lot of intuition. We do know that higher loan balance, they're gonna every would expect them to prepay faster when they're in the money, and they do. So we have a lot more and then we also, and this is important, the biggest liability that most homeowners have is their mortgage, right? That's
Yes.
the home is the biggest asset. Mortgage is their biggest liability. Um, so what that means is the regulators are never going to leave it alone.
Yeah.
The regulators are not going to leave it. Congress is not going to leave it alone. State regulators are not going to leave it alone. And you have these constant interventions which will impact how we look at the data and how we use the data. I think that my favorite example is a fairly recent one, COVID. Um, we see a very strong relationship between unemployment and credit losses. The higher the unemployment, or the bigger the unemployment change is the way we put into our models, um, the higher will be the credit losses for that loan or that pool of loans. No question about that. But during the COVID period, there were reporting changes, there were moratoria that went into effect, and importantly, the unemployment. Most people were better off being unemployed with the COVID relief than being employed.
Crazy
Um,
times. COVID
and
was
and
crazy
that
times for sure.
that entire relationship broke down. So what would happen is if you just said, okay, I'm going to throw this into a random forest, model and come up with it wouldn't know that, again, that's the context, that's the subject matter knowledge. And it would dramatically underestimate the relationship. You might even get the wrong sign between credit losses and unemployment changes. And so one solution to that is to underweight or even eliminate that with building your credit
All right, so let's talk about that. You've gone to exactly where I was driving. It's not straight up the loan attributes that drive the prepayments, the defaults, the delinquency, the timing, the foreclosure losses. You have to factor in macroeconomic factors, whether it be national or MSA specific. And it means unemployment, interest rates, house pricing, inflation, all that stuff.
right.
Um, Talk to us, and you kind of started talking about before. This is a kind of what I've always used to say. You have to be able to have the data through the cycle so you can
Yeah.
actually understand the impact on these different economic scenarios to
Yeah.
how borrower behavior actually occurs.
Yeah.
Talk to us about that a little bit. Can you expand that a
Sure.
little bit further?
Sure, sure. No, it's a great thing, and we can talk about then that will bring us back to the great financial crisis, right? So if you think about, okay, I want to build a model that will take inputs and produce an output. That's pretty much the definition of a model. And I want to think about how those variables maybe interact and how sensitivities may change and so forth. And then what I want to do, whether it's a classical, regression or logit procedure or something more machine learning oriented, I have free parameters and I want to try and calibrate those parameters. So that's the context that anyone building a model, anyone building a model faces. Okay, history is whatever history happened to be. I don't get to. I would love to go back and say I'd like to see this scenario. I'd like to see this scenario, but history is whatever it is. And if we go back, to give you an example, going back to the great financial crisis, sitting in 2006, building a credit model in 2006, we didn't know. We didn't have any historical data on loan. What do borrowers do when their LTVs are 130? No originator creates loans that are 130. The only way you get 130 LTV is for home prices decline by 30 or 40%. And they
Correct.
did. But we didn't know that sitting in 2006. So you ask, like, what went wrong? One of the things that went wrong is uh, the nobody had any empirical data on what does a borrower do when their LTV is 130 or 140. We didn't have any historical data to calibrate that. So you use judgment, and I don't think anyone would have thought that there were you go back, there were websites on how to walk away from your mortgage, how to strategically default, and there's been a whole cottage industry of very good papers looking at what percentage of loans defaulted, strategically defaulted. So in other words, the borrower could have made their payment but chose not to. They defaulted, and then
I always referred that to as the hidden stimulus. So people in these states that took the foreclosure forever, they just decided not to pay their payment and didn't have to make that. So they basically got a stimulus check through the
Yeah.
process, and I call it the
Yeah.
hidden stimulus.
Yeah.
Would you agree with that
Yeah,
that
no, that's
concept?
absolutely right. That's absolutely right. And yeah, so I think there were two issues, with the great financial crisis. One is nobody had any empirical data on what's going to happen to high LTV loans because we hadn't had home price declines where we had good data to calibrate that. The other thing is we were running stress scenarios where home prices were down like 2%, because we hadn't seen a broad home price decline for quite a few years. So, just because it hasn't happened before, it doesn't mean it's going to happen in the future. But nobody was running, okay, what happens if Florida's down 30%,
Yeah.
peak to trough, which is what happened.
Yeah.
So, you know,
So
um,
that was the birth of the stress testing from the Federal
yeah,
Reserve, where you had to
that's
have a base
exactly right.
case, adverse case, and a stress case, where it really looks at the capital requirements and the impact of the assets on that capital to make sure that they can withstand another credit crisis.
That's exactly right. That's exactly right. And another thing that caused all these problems with liquidation timelines and so forth is that the servicing industry was very boring, up until 2006. You're collecting payments and then it's a handful of people where you have to go to law smith and so forth. But the industry was not ready. You can't take someone who's making collection calls, or sorry, someone who is doing administrative work at a servicer and turn them into a locksmith specialist overnight. In fact, you might not be able to do that at all. So
Yeah.
the industry simply wasn't prepared for the onslaught. That's another thing where, if you look at how loans migrate from delinquency and how they get resolved, that's another thing which has changed dramatically in where you really have to, use your subject matter expertise.
So with the last few minutes we have here, I want to get your opinion on realistically in the residential world, what challenges are ahead of us, or where do you see the bright spots? Give me your crystal ball. Tell me what you see coming up in the next year or two or three.
Yeah, I mean, gosh, I don't have a crystal ball, Joe. If I did, I'm 67. If I had a crystal ball, I'd be retired by now. I think that, I think that one of the interesting things that's going to occur with mortgages is that more data is becoming available. And that's going to be, it's going to enable us to sharpen our models, in particular data from credit bureaus, where we can look to see the borrower's total indebtedness and not just the mortgage indebtedness. And that's going to help inform more precise modeling. Um, One of the this we've talked about alternative credit scores. I think there's a lot of discussion around that. I don't look at that as a big issue. We're set up to handle different credit scores, but I don't look at that as being a game changer because the real issue with homeownership is that people can't afford homes. It's not that they don't. It's not like there's a large population of individuals out there who have a Vantage score, but they don't have a FICO score. Those are not generally households that are even close to homeownership in any sense of the word. I
I
think
understand.
government action on these LLPAs. th- those are those can be seismic changes to prepayments and even credit. And I'll give you, I'll leave you with one thing. So I think policy risk is heightened now, particularly because we have very different views about how LLPA should be structured from both um, the left and the right in this country, and they can be massive changes. Again, if we go back to the post-crisis period, we had all these loans that were prepaying very slowly because their LTVs were very high. And, there was a lot of trading. It's like, these are great loans to own because I get a nice high coupon and I'm going to have that for a long time because prepayments are low. But then the government announces HARP, and then they expanded it, the homeowner refinance program. And all of the premiums that people were paying will go away. So I would say Policy risk is something to keep an eye on. It's very tough to handle, but it's hard to forecast and it's very impactful.
All right, Dick, we're out of time today. Well, first of all, I want to thank you so much for joining us, and I want to thank everyone that took the time, the 30 minutes out of their day to listen to this conversation. I just enjoy immensely having these conversations every, twice a month. And with today's conversation with Dick was great. It's one of those areas that is so sometimes difficult to understand because it's so complicated. And Dick, thank you so much for coming and explaining to us very simply. Um, so for everyone, the Acre Exchange is the second and fourth Tuesday of every month at 12 o'clock Eastern Time. Please take time to follow Acre, myself, Joe Furlong, and Dick Kazarian on LinkedIn. We would greatly appreciate that. Please register for the next episode coming up in just 2 weeks. And to that end, Dick, thank you for your time and all your knowledge you conveyed today.
It's been a pleasure, Joe. Look forward to our next get together.
Thank you. Until then, everyone, have a great day.